Imagine waking up tomorrow morning and discovering that every loan in America had disappeared overnight. Every mortgage, every car loan, and every credit card balance. Gone. At first, it sounds like a dream, but almost immediately, banks across the country would lose their primary source of revenue, and the American financial system would begin to collapse. This reveals a gap in how we're taught to think about money. We grow up believing banks are simply giant, secure rooms where our cash sits and waits for us. But a bank is a business. Its survival depends entirely on the interest generated by people who owe them money. This raises a question. If debt is so dangerous, why do companies like Apple, who have billions in the bank, routinely borrow billions more? You see the same behavior with the ultra-wealthy. These are people who could pay cash for anything, yet they continue to take out massive loans. These decisions aren't mistakes. They are driven by the specific mathematical relationship between interest rates, taxes, and asset growth. When those variables perfectly align, debt completely stops functioning as a liability and instead starts functioning as an asset. To understand this, we have to look at what a bank actually does. A coffee shop sells coffee. A bank sells access to capital. Imagine a town where 100 people deposit $1,000 each, creating a $100,000 reserve. Since not everyone needs cash simultaneously, the bank lends those funds to families and entrepreneurs, charging interest. But banks don't benefit when borrowers fail. Just like a bookstore wants a customer who buys books every month and pays on time, a bank wants a reliable, long-term relationship. They need successful borrowers to pay that interest. Without them, the bridge connecting today's savings to tomorrow's growth disappears. For a corporation, borrowing isn't about a lack of cash. It's about using that cash more efficiently. If a business earns a 20% return on its investments, but can borrow money at a 5% interest rate, that gap represents a massive opportunity to accelerate. This math is why companies use debt to build factories, hire thousands of employees, and scale operations years faster than by just saving profits. In this context, the loan doesn't create the success. It acts as a strategic amplifier for a business model that is already working. This logic also applies to individuals, where identical loans can lead to completely different lives. Consider a neighbor who takes out a $40,000 loan for a luxury car. It's a beautiful asset, but it immediately begins to lose value. Every month, the loan payment drains their income, while the car itself is worth less and less. Now consider a second neighbor who takes out the same $40,000 loan to purchase a modest rental property. In this case, the tenants pay the rent, which covers the mortgage and maintenance. If managed well, the property creates a monthly profit and grows in value over time. This is the same principle that built the modern economy, allowing farmers to buy equipment, doctors to open clinics, and engineers to launch companies. The first neighbor used consumption debt to purchase something that drains wealth. The second used production debt to acquire an asset that generates it. This is the core of the billionaire strategy. Most of their wealth is held in assets like stocks that increase in value over many years. Selling those stocks would trigger huge tax bills and stop their future growth. Instead, they borrow cash against the value of those stocks. By using debt as a shield, they get the cash they need while their wealth continues to compound, effectively turning the traditional idea of being in debt on its head. Ultimately, debt is a neutral tool, much like electricity. Used for consumption without a plan, it can be destructive, but used for production, it powers almost every major advancement in the modern world. Before signing a loan agreement, the most important question you can ask is whether the future value that loan creates will exceed its total cost. The greatest financial advantage doesn't belong to those who simply avoid borrowing. It belongs to those who understand the mechanics of how value is created and when to use the right tool to build it.